Most people believe investing is only for the rich, or that you need thousands of dollars before you can even begin. But the truth is, you don't need a large amount of money to start investing in the US stock market. You can begin with as little as $100, and if you stay consistent and patient, that small amount can grow into something meaningful over time. Investing isn't about how much money you start with, it's about starting early, building good habits, and letting time work in your favor. When you invest in the stock market, you're not gambling or guessing. You're buying a small piece of real companies. Companies like Apple, Google, Amazon, and many others sell shares so they can grow their business. When these companies grow and become more valuable, your investment grows with them. Thanks to modern investing tools, you don't even need to buy a full share anymore. You can buy fractional shares, which means even a small amount of money can give you ownership in large, successful companies. Before you can start investing, you need a brokerage account. A brokerage account is simply a platform or app that allows you to buy and sell investments. Most US brokerages today are beginner-friendly, have no minimum balance requirements, offer zero commission trades, and allow fractional investing. Opening an account usually takes just a few minutes. Once your account is set up and funded, you're officially ready to start investing. Now, the big question becomes where to invest your first $100 to $1,000. If you're a beginner, it's usually best to keep things simple and avoid unnecessary risk. One of the smartest options is investing in ETFs, also known as exchange-traded funds. ETFs allow you to invest in many companies at once instead of putting all your money into a single stock. This diversification helps reduce risk and makes ETFs a great choice for beginners. Another strong option is index funds, which track the overall market, such as the S&P 500. Historically, the US stock market has grown over the long term, and index funds allow you to benefit from that growth without trying to pick individual winners. You can also consider blue chip stocks, which are large, well-established companies with strong track records. These companies may not grow as fast as risky stocks, but they tend to be more stable and reliable over time. A simple portfolio can go a long way. For example, you might put most of your money into a broad market ETF, add a small portion into a few well-known companies, and keep a little cash on the side. You don't need a complicated strategy or constant trading. In fact, overtrading often hurts beginners more than it helps. The goal is steady growth, not quick profits. One of the most powerful concepts in investing is compounding. Compounding means your money earns returns, and then those returns start earning returns of their own. Over time, this creates a snowball effect where your investment grows faster and faster. Even small monthly investments can grow significantly if you give them enough time. This is why starting early matters more than starting big. Time is one of the most valuable assets an investor has. Many beginners make the mistake of letting emotions control their decisions. When the market goes down, fear takes over and people panic sell. When the market goes up, excitement leads people to chase hype and buy at the worst possible time. The market will always move up and down, and this is completely normal. Successful investors understand this and stay focused on the long term. Instead of reacting emotionally, they stick to their plan and remain patient. Another smart approach for beginners is investing consistently over time instead of all at once. This strategy is called dollar cost averaging. It simply means investing a fixed amount of money on a regular schedule, such as weekly or monthly, regardless of what the market is doing. This reduces the stress of trying to time the market and helps smooth out price fluctuations. Consistency often beats perfect timing. It's also important to have realistic expectations. Investing is not a get-rich-quick scheme. You won't double your money overnight, and anyone promising guaranteed fast returns should be avoided. What investing can do, however, is help you beat inflation, grow your wealth steadily, and move closer to financial freedom over time. Slow, steady progress is far more powerful than risky shortcuts. The most important step is simply getting started. You don't need expert knowledge, perfect timing, or a large amount of money. Start with what you have, invest in simple and diversified options, and continue learning as you go. With patience, discipline, and consistency, Even a small investment can grow into something meaningful. If you found this video helpful, consider liking it, subscribing for more simple finance content, and sharing it with someone who wants to start investing but doesn't know where to begin. Your future self will thank you for starting today.